In this concluding lecture of this section, I want to talk about the state of the global markets as we see it at the end of 2015, perhaps 2016. But some of these are macro trends. You want to look at a couple of years to get a proper idea of the trend that's happening. So, as of 2015, as of the end of 2015, global assets are still growing, both equities and fixed income. All global markets have been up since the 2008-2009 crisis. They've all come up quite well, and therefore global assets are still growing. The US remains the largest market with 57% of the world's financial assets. Now, I need to clarify this. What we are not saying here is that the US has 57% of the world's wealth. We are not saying that. What we are saying is the US remains such a popular destination for investments, even in the financial markets like our bond markets and stock markets, that investors from around the world find it attractive to put their money in the US. The money is theirs and any profits that they make and take it to their respective countries. But what we're talking about is as a financial market, the US remains the largest market and it invites investors from all over the world. Europe and cross-border, when we say cross-border, we're talking about the Eurozone where things are just moving freely. So Eurozone is the next biggest with about 25% of the world's assets, financial assets. Once again, it doesn't mean those all belong to the European countries. It belongs to investors from around the world. Asian financial assets are still low, but they are the fastest growing. So places like China, Hong Kong, Japan, India, where financial assets from around the world are still low, but they are the fastest growing. Now, the most important thing is in January 2016, where we are right now, when this course is being made, global markets are cautious. Since the beginning of the year, all markets have been coming down. China has slowed down pretty dramatically. Commodity prices have crashed. The complete oil and energy market has been decimated in the last few months. Gold is starting to get stronger because you'll see that gold acts as a safe haven and the US dollar also acts as a safe haven when there is a sense of concern in global markets. And so we'll look at all of that in future sections, but gold is starting to get stronger now. Japan moved into negative interest rates, and this is pretty amazing. If you give your money to a bank in Japan, you have to pay them interest. And so you can imagine what kind of a situation is driving these countries to make policies like this. Europe is facing some deflation. The US economy seems to be holding quite well. However, you have to look deeper into the numbers. Our labor participation rate has not been improving. In fact, it's been worsening from the last 5 to 10 years. And our median income in the US has not been increasing. And so those are two concerns. But otherwise, the US economy seems fairly well footed at this point. But lots of volatility is expected in 2016. Volatility can come from any kind of situation. It can come from the oil and the energy complex that we are seeing in 2016. It can come from some geopolitical issue. It can come from war. It can come from a lot of things. But 2016, I think it's safe to say that there's going to be a lot of volatility. It remains to be seen how 2016 will play out in the markets. So to summarize, I want to just capture all the points that we just discussed. Money is going to flow where it can get a return on investment. And especially we're talking about institutional money. Those are in billions and hundreds of billions and trillions of dollars. And therefore, even a small increase in return is going to make a big impact on that kind of a base. Money flows to other countries through two channels. One is called the FDI, where money is invested directly into factories and plants and things like that. Or it's invested in the financial markets, and that's called the financial institutional investment channel. And we are right now only talking about the FII. So, we're not talking about investments into FDI, which is the foreign direct investment. So emerging markets obviously has been a favorite in the last 2 decades, but they're also very volatile because their systems are not mature enough to handle large amounts of inflows and most importantly, large amounts of outflows. So in the 2008 crisis, the US companies had to take their money out from all these countries because they had margin calls in the US during the 2008 crisis. And that created a huge amount of volatility in emerging markets. And in fact, the emerging markets actually went down much more so than the US markets. Now, the BRICS are, of course, the old news. We are talking about Brazil, Russia, India, China, Korea, South Africa. So these are old news. They are now in the emerging market category. They're well footed in the emerging market category. Some of these are very large economies now. There are also other frontier markets. Newer markets are opening up. Markets like Indonesia, Vietnam, Sri Lanka, and even Mongolia are touted as the next big opportunity. So these are called the frontier markets, where now money's seeking return, because the BRICS are getting a little matured. And so your return possibilities in the BRICS are going to be less attractive than some of these newer markets, because newer markets always, when you get in early, you can capture some of the best returns. So big institutional money is always looking for these kinds of opportunities. They have the ability and the muscle to go around the world. When we look at the section on ETFs, you'll realize that ETFs have totally opened up the world to everybody, including individual investors. So you can today invest in any corner of the world through an ETF in the US market itself. So just to summarize, global money flow is massive. And this money goes where there is return of investment. If one location seems less attractive than the other, money will be pulled out from there and redeployed into another area. This is a constant money management effort that goes on all the time, and we're talking about huge numbers. So we're talking about hundreds of trillions of dollars. And so the takeaway from this is, if you can see an opportunity where money is flowing into some country, after this course, you will know how to take advantage, because there is a way to invest into that kind of opportunity.